Us here today.
Yes, and first and foremost, thank you to Kyle. Thank you to Eminae. Eminae is a group that I've been part of now, I think 5 or 6 years. When, as Kyle mentioned, it was I think about 8 to 10 people, and we just met in restaurants in a small room, and it's certainly grown over that time. Mostly due to Kyle's efforts and his leadership, and it's a tremendous organization that I've seen over the years. With its mission as first and foremost, educating business owners and entrepreneurs and empowering them to make the most of the business that they've built and help them understand the best ways to leave something for themselves, for their family, for their loved ones. It's really a great group with great people. So happy to host you all here. Welcome to Rivkin Radler. As Kyle mentioned, I'm one of the partners in the corporate practice here. Our practice focuses on middle market M&A. We represent both buyers and sellers across all industries, all over the country. We even get involved in cross-border transactions as well. So any buyer, any seller, we're happy to dig up our sleeves and try to roll up our sleeves, and help. Today's topic is anatomy of a purchase agreement. We're gonna go through the nuts and bolts of the various sections, talk about what you would expect to see in a typical purchase agreement. And we're gonna be focusing mostly on the perspective of the seller here. Figured it was just easier to pick a side rather than go back and forth, but fairly intuitive. Generally speaking, whatever's good for the seller is less good for the buyer and vice versa. It's kind of a zero-sum game, but what I love about M&A as opposed to other areas of law is that an M&A deal is really a collaboration. Unlike in a litigation context where you can try to win a point, bully the other side into submission, get them to give up, doesn't really work in a transactional environment. Ultimately, at the end of the day, you need somebody to sign on the dotted line. And the dotted line that they're going to sign is typically going to be at the end of a purchase agreement. And in order to get everyone together in a room, virtual or real, you need to have a meeting of the minds. You need to find areas where we can agree to disagree or find ways to split the difference and get to a place where everybody's comfortable with moving forward. Because the closing of an M&A deal often is really more of the beginning of something than the end for many clients, especially in the increasing private equity takeover of private companies. They're usually expecting to see management continue, so it's really more of a partnership than we're drawing a line in the sand and you could kind of go your separate ways at the end of the deal. So first and foremost, the question is, why the purchase agreement? Why is this a useful thing to focus on for a seller who maybe is thinking, maybe in the next 5 years, I want to sell my company? If a seller were to ask, why is this something that I'm even wasting my time thinking about? Like, let me know when we're ready, when we get that first draft from the buyer side, then we'll look at it. And not just because I'm a lawyer and my focus is on the purchase agreement. I think there's actually very practical reasons why this is a good exercise for any seller, any advisor of a seller to focus on as early as possible in the process. And the first reason is that I just find in general, in life, in practice, in work, it's often very helpful to start at the end and then work backwards and see how we're going to get there. And the reason for that is that while every deal has its own story, can have its own journey, sometimes you start with an LOI, sometimes you start with various indications of interest, sometimes you're in an auctions context, sometimes you're selling to your employees. It's always a different story of why we're selling, how we get to selling. Almost every deal is going to end in the same way, with a signed purchase agreement. And looking at the purchase agreement allows a seller and his or her advisors to develop a roadmap. Because now we know where we need to go, and now we need to figure out how we're going to get there. And how we're going to get there is going to involve all the various opportunities, problems, risks, things we're going to have to solve along the way. And in my expert opinion, the sooner we know about those things, the sooner we know what the hurdles that we're going to have to jump through are, the more likely we are going to be able to clear those hurdles. The last thing you ever want in a deal is for some big issue to arise when we're on the 1-yard line, and now all of a sudden everyone's running around trying to solve it with a deal that's supposed to close tomorrow. The sooner you put everything on the seller's radar of here's all the things that you could expect, that you will have to agree to, that you're going to have to give away, that you're going to have to relent on, the more likely it is that when you get to the finish line, everybody's ready to go through. The second reason, I had a former colleague who used to joke, and I think it's, there's more truth than joke to it, that there's only two things that are negotiable on an M&A deal. The first one is the price, the second one is the terms. Now, that's definitely an overgeneralization. Terms is all encompassing, but there's something to it in that most sellers intuitively understand what price means, and they can negotiate that on business terms with their broker, with their accountant, whoever is advising them on the financials. $50 million means $50 million. But what are the conditions to get that money? What do we have to comply with in order to get that money? What is the risk that some or all of that money can be clawed back from us? These are the terms of the deal. $50 million tomorrow is not the same as $50 million 10 years from now, only if XYZ conditions are met. So that's where the full color gets painted alongside the purchase price, which, can be the flashy thing that gets the seller interested in saying, okay, oh, great, $50 million sounds like a great deal, let's do it. When you fill in, okay, well, here's what goes along with that, that's when you get the full picture of what the deal actually is. And the last thing that I like to think about is thinking about this from, if you're a seller, you got to think about the deal from the perspective of the buyer. Why are they writing you that check? What are they getting out of this? And the answer most of the time, and again, this is a little bit of an overgeneralization, but what the buyer is getting is the purchase agreement. They're getting a contract that says, A, this company that you used to own, now I used to own. And the reason why I know is because it says so right here and you signed it, and now this is my company, not yours. It also memorializes all of those things that you're giving to the buyer in exchange for that check. And we'll talk about these things over the course of the presentation. You're giving them reps and warranties. You're giving them an agreement not to compete in that business for a certain period of time. You're giving them various rights and remedies if something goes wrong. So the exchange is purchase price, essentially, for contracts that the buyer gets the benefit of. So again, thinking of it from the perspective of the buyer allows a seller to anticipate the issues that come up, allows them to put themselves in the buyer's mindset. Why is the buyer doing this transaction? What are they expecting to get out of it? And what am I going to have to give them to ultimately get them to sign over that check? So over the next 20, 30 minutes or so, however long this lasts, we're going to kind of go through the various sections of the agreement, which I've outlined over here. I would say, 80 to 90% of agreements follow this general structure. Normally we start out with just, a series of definitions. We're not really going to get into that, but just always, when you're looking at an agreement, you always want to make sure that you're going back and forth between definitions and the body, the document, make sure that you understand what everything means. Make sure that, just because you think you have an understanding of what the term debt means, you need to know the broader way that debt is defined in this agreement. It might be incorporating concepts or line items that you didn't necessarily expect. So just always important to keep definitions in mind. Article 2 is usually going to be purchase and sale, which essentially is the description of the transaction, like on a very high level, holistic basis. Like, what are we even doing here? Who is giving what to whom? Who is paying what to whom? What is the overall structure and business deal of the transaction is essentially going to be covered in this section. Article 3 is the closing. This will describe when are we closing, where are we closing, are there conditions to close, are we closing the same time we sign this agreement or sometime in the future, what else am I required to bring to the closing other than a pen, kind of the buyer's case, a pile of money. Articles 4 and 5 are going to be the representations and warranties, and these go both ways. The seller makes representations to the buyer makes representations to the seller, although usually not nearly as many, because after all, they're the ones buying. Article 6 is covenants. So the difference of people often lump together representations, warranties, and covenants like in one bucket, and I kind of think of them interchangeably. Good rule of thumb, representations and to a lesser extent warranties are time driven as of a moment of time and backwards. So representation is usually, I'm telling you something about as of now. So for example, I've paid all my taxes. Or you're representing something about the business going backwards. During the last 5 years, we've complied with all the laws that are applicable to this business. A covenant by context is forward looking. It's your obligation in the future to do something or to not do something. You have an obligation to file tax returns on behalf of this business in the future. You have an obligation not to compete with the business. Those are both examples of covenants. And then finally, we have Article 8, indemnification. This is every seller's worst part of the agreement, because this is the part of the agreement that says, if any of the things in the other sections that you were supposed to do or that you were supposed to tell us turned out to, you didn't do them, or you did them wrong, or you told us something that wasn't true, or in any number of ways that something in this agreement was breached, and as a result, buyer now didn't get the bargain of its benefit, didn't get a business that was worth $50 million that they paid for, what rights does the buyer have to come back to the seller and say, you owe us some of our money back, or you owe us some other remedy that allows us to be put into the place that we expect it to be by virtue of our agreement. So we're going to go through these one by one. At any point, please, if anyone has any questions, this hopefully is meant to be interactive and not just a lecture. So feel free to chime in, feel free to ask, and hopefully we all learned something. Okay, so first and foremost is the purchase and sale section, which, as I said before, this is where we describe like what's actually happening here. Who's the buyer, who's the seller, who is selling what, who is buying what, and what are they getting for it? And the first threshold question that frankly will almost always be decided before you even get to the purchase agreement section, it's usually going to be determined in the letter of intent section or sometimes even earlier, is what are we selling? Is this going to be structured as an asset sale, or is it going to be structured as a stock sale? In theory, it could also be structured as a merger, although that's pretty uncommon in the like middle market private company context. It's much more common in public companies or companies with large shareholder bases. So we're just going to kind of put that aside for purposes of this presentation. Just wanted to make sure it's something we didn't just omit to mention. Yes.
So who's usually drafting the agreement? People ask us that all the time, the buyer or the seller's attorney?
Almost all the time, the buyer will draft the first draft. It's different in the real estate context. It's usually the opposite. And the tradition, I think, usually it flows from what I said before, that the contract is really for the buyer's benefit. So that's kind of like the custom, is that buyer will do the first draft. So threshold question is going to be, are we selling assets or are we selling stock? And the TLDR answer, as they say, most of the time, you're going to want to be selling stock, but you're going to be selling assets. And we'll get into why that is in a few moments. But just so that we kind of understand a little bit of what we're even talking about here, I drew some pictures that I think are potentially helpful. The analogy that I like to think about it is because when you're selling a house, people can kind of get their head around a house more than the sale of a business. So when you're selling a house, the simplest way to think about it, selling a business, is a stock sale, because that's like what people are used to, right? Like you own 10 shares of Apple that you bought in your Fidelity account, you want to sell them, you're selling those shares. Kyle used to own the shares, he sells them to me, now I own the shares. And that's the same thing that would happen in a stock sale, except instead of Kyle owning 10 shares of Apple, he owns 100% of the shares of Apple, or 100, him and his partners do. And they're going to sell those shares to me. So
You should be so lucky.
yeah. So nothing in a stock sale, nothing actually happens to the target company itself. All that happens is that its ownership changes. So in a house example, today I own a house. Sean comes over to me and says, "Hey, nice house. I'd like to buy your house." He hands me a check. Now the house, the land, everything that goes with it now belongs to Sean. On an asset sale by contrast, would allow me to get the benefit of the house and everything that comes with it without buying the actual house. So assume we don't want the walls. That's just what the house is located inside. But on an asset sale, basically what I would be buying is everything that the house contains: the staircases, the tables, the floors, the electrical wiring, the HVAC ducts, everything that is an asset of the house, I can buy without taking the four walls of the house on an asset sale. So looking at these pictures kind of describes what I'm talking about. So acquirer is going to be it's usually going to be an entity that's buying, whether it's stock or assets. And as you see at the top, the target shares just transfer directly from the target shareholder to the acquirer. Money goes from acquirer to target shareholder. On an asset sale, by contrast, the transaction technically happens between the target company and the acquirer. So rather than shareholders selling directly anything to the buyer, they are causing the entity or the house that owns all of those assets to transfer them to a new company. So rather than the whole thing moving over, only the components move over. So as we go back here, the reason most of the time why that will drive the decision of whether to be buying assets or buying stock are the next two things on this slide: liabilities and taxes. So we described the process where you go into the house and you pick all the assets that you want, and you get to take those along with you on an asset sale. The more important thing that you're worried about, and why you would a buyer would want to choose the asset sale, is to make sure that they're only taking the liabilities that they chose, that they saw in the house. Anything that they don't know about, that they don't explicitly agree to take, stays in the house. So if you don't want to pick up the water bill, you don't want to, maybe somebody slipped and fell in the house in the last few years and there could be some lawsuit pending against the homeowner, we're going to leave that behind. But the fixtures, the tables, everything that's good about the house, everything that's good about the business, we're going to take with us into our new company. So that's the reason number one that a buyer wants to buy assets and not stock. By contrast, the seller is more eager to sell the stock. That way they can essentially dispense of all of those liabilities without worrying that they're going to remain with them, although there's ways that buyers protect themselves there too. And then the second reason is, as is generally the reason for most reasons in life to drive a transaction, is the tax treatment. And most of the time, a buyer will get a more beneficial tax treatment by buying the assets of a company, because it'll put them in place where when they go to sell the company, they will get to avail themselves of the benefit of a step up in the basis. You could speak to Paul afterwards to explain to you what basis means. But essentially, the buyer will incur less tax on the resale if they buy assets most of the time than if they buy stock. By contrast, a seller will get a better tax treatment on their sale by selling stock most of the time, because a stock deal will typically be classified as a capital gains event, where you bought the stock for $10, you sell it for $20, you pay capital gains at, I think is 20%, 15-20% these days, on the spread on the $10 of gain that you had. Whereas on an asset sale, depending on the type of assets, there are certain assets that when you sell them, they're taxed as capital gains treatment. There are other types of assets that are taxed as ordinary income, which is the highest, 35 to 39%. And depending on the nature of your business and the type of assets that you are selling, you will end up with some sort of hybrid between the capital gains and the ordinary income, but that will 99 out of 100 times result in higher taxes being incurred on the seller than if they had sold stock. So sellers generally want to sell stock, buyers generally want to buy assets. Buyers usually are the ones driving the deal and insist on an asset sale. There are ways sometimes that you can, depending on the seller's leverage, you can push for some sort of gross up or some sort of ability to increase the purchase price to make up the seller the amounts that they lost. But generally speaking, that's going to be how the structure is determined. The primary exception and the reasons why you may sometimes see a buyer not only agree, but require the deal to be structured as a stock sale is because of the nature of an asset sale. So remember when we talked about how you're moving all the assets from company A to company B instead of just leaving them where they are and buying the company. Because of that, you need to retitle all of the assets in the new name. So if the seller owned a company called ABC Inc., and now you're moving over all of the assets to a new company called, let's say, XYZ LLC, the problem becomes now we have contracts that are in the name of ABC Inc. We have permits that are in the name of ABC Inc. We've been running a business under the name ABC Inc. for all these years, and it could be that causes issues with our ability to just transfer things from one to the other. Many of the times you can do that. If you own a piece of equipment, there's nothing that prevents you from selling that piece of equipment. But if you have a contract that you're a party to, often the contract will provide that the other party in the contract has the right to consent to your ability to sign that contract to somebody else. They went into business with you. They didn't necessarily agree to go into business with some other future owner, and they may have the right to avail themselves of the right to say, we're not going to agree to continue this contract unless, we get information, you tell us what's going on. We want to meet these owners. The most common situation where you face this is in your lease, right? Almost every lease will say that on a sale, you need to get the consent of the landlord. The landlord doesn't just want some new person coming into their building that they didn't have a chance to vet, to run background checks on, credit checks, all the things that a landlord would normally do. They're not going to let you circumvent that just because you're selling your company. Similarly, permits, depending on the type of permit, they're very, very highly specialized. There can be a long process to get a permit. For example, if you're a doctor, you can't just sell your business to me and now I'm a doctor. That's not how being a doctor works. If I wanted to buy your business, I would need to show the government that I have all the proper permits to run this business. And depending on the type of permit, the type of industry, that process can be arduous. We've faced situations with clients where to assign a permit was like a 6-month period, and no one was going to sit around and wait 6 months for like the New York Department of Health to decide if they're going to approve this transaction. So in that situation, the buyer would have no choice but to buy the stock, because buying the stock would be the only thing that allows them to keep the permit on day one and keep the business running. So those are a couple of major things that would cause you to choose a stock sale, even though it's not as advantageous to the buyer from the perspectives that we talked about before. So when we talk about asset sales, I kind of got into this a little bit. I think you kind of already described this concept, but we normally we break out everything that entails the business into 4 buckets. And within, first of all, we have just, our 2 sides of our balance sheet ledger. We have our assets and our liabilities. But as we described before, we have the ones that are either being purchased or assumed, our purchased assets and our assumed liabilities that are going to go along with the business. And then you have our excluded assets and our excluded liabilities, which are staying behind and remain the possession and or obligation of the seller. Purchased assets, it's almost always going to be all the assets or substantially all the assets. The point is the buyer wants everything that's good about this business. They want the hard assets, they want the intellectual property, they want the goodwill, the intangibles, they want the right to hire all the employees. Employees are assets of a business. Generally speaking, the only types of things we're going to leave behind are like the corporate records and minutes books. Certain like employee benefit assets will stay behind, but generally speaking, everything that has any value to the business, the buyer wants to take. Anything that has no value to the buyer gets left behind. Sometimes you'll see a carve out for like, personal assets. I've never encountered this, but I've heard a rumor that sometimes in like family-owned businesses or small businesses, there are assets of the business that really the owners view as their own assets, like sometimes a car or a laptop or artwork that, on paper belongs to the company, but the owner expects to keep. We'll typically want to see those treated as excluded assets as well to make sure that, your memorabilia in your office doesn't all of a sudden get taken out of your office on the day of closing. In terms of liabilities, almost everything is going to be an excluded liability, right? The buyer wants almost all liabilities to stay behind and remain the seller's obligation. The general exception, almost always an exception, is to the extent that we're taking a contract, any liabilities under the contract starting with the closing day and going afterwards, intuitively, those are going to be the buyer's responsibility. They're going to step into the shoes of that contract and be responsible for performance and payment on those contracts going forward. Depending on the deal, buyer may also assume some or all of accounts payable and accrued expenses, but that, that's deal specific, depends on how you're treating the working capital of the business on a particular transaction. Okay, the fun part. Why are we doing this deal? Somebody's giving us some money or some form of consideration one way or another. I hope that's why we're doing the deal. Hopefully we're getting something for it. So when we talk about purchase price, almost always primarily we're talking about cash. We're getting cash in some form, in some amount over some period of time. Increasingly common, especially as we said before in the private equity context, is for buyers to also get some form of property. When we say property, what we're generally speaking about is some sort of security, stock, LLC interest, some sort of rollover consideration whereby we often will see that a buyer will say, instead of giving you 100% in cash, we're going to give you 90% in cash. And that last 10%, we're going to give you that value in the form of stock of the parent company or the holding company into which we're folding you in. And this accomplishes a number of goals. Number one, less cash to come up with for a buyer. That's great. Number two, the point is to kind of align interests between buyer and seller on a going forward basis. Because as I mentioned earlier, often you'll see that a buyer wants management to stay in place. They want them to remain incentivized. They want them to keep working hard for the company. They don't want them to sell the company and then go on permanent vacation. They want them to have skin in the game to continue growing this company so that when buyers returns money to their investors, they can also return some of that piece back to the original shareholders. In terms of timing of payments, what I like to tell my clients that the most important number in any agreement is the number that comes right before the words payable in cash at the closing. The amount of money that you get at closing that you get to put in your pocket, if that amount of money doesn't work for you in terms of it being a good deal, you should not do the deal because everything else in the deal is contingent. It's contingent on buyer being able to pay it to you sometime in the future. It might be subject to conditions. If they're giving it to you in the form of stock, you have no idea what's going to happen to this company. Maybe it's going to triple in value. And, I've seen clients who make more money on their rollover shares than they did on the original sale. And that's incredible when that happens, but you can't count on it. So you need to be comfortable as a seller and as advisor of the seller that the amount of money that they're putting in their pocket at closing is enough that it's worth doing the deal if that's the only money that they get. We increasingly are seeing money being paid over periods of time, both in the form of just non-contingent deferred payments, often memorialized pursuant to a promissory note. It's a way to help buyer bring in a seller to finance part of the deal. It also gives them some skin in the game. And even more increasingly, I would say, especially over the last 2 years, in this uncertain economic environment, as they're calling it, the use of earnouts has become increasingly popular. It's a good way, often when there's a gap between buyer and seller on valuation of the company, to kind of bridge that gap. So if I'm a seller and I think my company is worth $30 million and the buyer's model gets them to the point where they think it's only worth 25, so an earnout is a way for a buyer to say, okay, we'll give you the 25, that last 5 that you think you're worth, show your work. Let's see that you're worth it, and then maybe you'll get it. So in that sort of structure, what you might see is $25 million paid at the closing, and then after a period of time, let's say a year, 2 years, 3 years, if the company has performed up to a certain threshold, it's certain revenue targets, certain profitability or EBITDA targets, whatever deal you make, and sometimes it's contingent on sellers continuing to work for the business for that period of time. You can make whatever deal you want in terms of what the thresholds are for the earnout to be earned. But if you hit those earnout targets, then you get the full 30 million and everyone's happy. If you don't hit the targets, if the business doesn't perform the way you promised us it would, then that last 5 million, you're not going to get it. It's gonna, you only get 25 million we paid you at closing. And that's, it's often used as a way to harmonize in those ambiguous valuation contexts. Yes.
Can you go into secured and unsecured debt a little bit?
Sure.
As pertains to that?
Yeah, so an earnout is almost always going to be unsecured. You do sometimes see earnouts that have a secured note attached to them, but that's less common. A deferred payment would sometimes, it's everything is negotiable in a deal. If you have either no note or an unsecured note, what you really only have is an unsecured promise to pay, which means that if the person doesn't pay you, your only right most of the time is going to be to go bring a cause of action against them and sue them and try to get the money. Which is, that's generally not what you want to be doing. If you don't have to now, depending on the amount of money, depending on how much it's going to cost to litigate, you may well avail yourself of that remedy. But what would be preferable is if you had a secured interest in the promise to pay, which allows you to file a security interest, a UCC, a lien against the assets of the buyer or the parent, or whoever it is that is is standing behind the payment obligation. And what essentially that does is, in the event of a down scenario where buyer is not able to pay its debts and has a list of creditors standing in line waiting to get paid from the cents on the dollar that are left from buyer's pile, being a secured creditor with a secured promissory note will put you higher up in the line. Now, you're probably almost definitely going to still be behind some of buyer's other creditors, namely if they're getting any sort of financing to finance this transaction, their primary lender who's financing, 80-90% of the purchase price, they're always going to be first in line no matter what. You're never going to skip ahead of them. So like in a real nightmare downward scenario, it might not matter, because if there's not enough money to pay the bank who loaned the money, there's not going to be enough money to pay for you. But you'll still be ahead of, their run-of-the-mill ordinary course vendors who also just have a, unsecured promise to pay, just like most of us do in life. Somebody owes you money, you don't really have a recourse other than to send them to collection, bring an action, try to get some money out of them. So yeah, it's certainly to the advantage of a seller if they can get a deferred payment secured, and you want to be as primarily secured as possible. Ideally, you want to be first in line. If you're not going to be first in line, at least be first in line behind that bank and ahead of everybody else.
Quick question.
Yeah.
On the earnouts, do you find certain industries just kind of dictate longer earnouts? Maybe they want someone to be around to kind of help them navigate, or is it really just?
I would, in my experience, I think it depends less on industry and more on the acquirer. When an acquirer is a strategic acquirer, think of big company buying little company, they are less sensitive to earnout requirements, because most of the time they will have infrastructure in place to run this business. Maybe not as well as the founders, but we can often fold it into our, we have a sales team, we have HR, we have everything that we need to make this run. When you're dealing with a financial buyer, they are almost always expecting management and key employees to stay in place. They're just putting money in, hoping to get a return. They don't really want to, they'll have a board seat so they can monitor what's going on, but they have no interest in the day-to-day. From the seller's perspective, we often will try to negotiate for certain covenants and restrictions that you want to put on the buyer if there's an earnout, because the last thing you want to do is be in a position where you hand over your business. A piece of the money that I'm expecting to get is based on how this business is performed, but I'm basically handing the keys to the car to you. And if you guys don't know what you're doing and you drive this business into the ground, or you decide, we don't really care about making money in the first 3 years. We want to invest a ton. We're going to, develop a bunch of new R&D. We're going to hire like crazy to try to grow and, flip this company in 7 years. Seller is going to be very sensitive to that, because if my earnout payment is based on you need to make $5 million of profit in a year, and buyer doesn't care about making profit in years 1 through 3, then that doesn't really work for me. So the key to the earnout is always making sure everyone's aligned. So you want to make sure that buyer is operating in the business in the ordinary course in a way to maximize profit, in a way to, at the very least, not screw over the seller. They need to have some flexibility to run their business. They do own it now. But you want to think about what guardrails you need to put on. Yes.
To your point, that's, why, I guess from the perspective from the seller, in the earnout, you would want to negotiate, as hard as you can, I guess, on reporting requirements and, details about financials, et cetera, which the buyer might push back on, because a lot of times finance people,
They don't like to share.
they don't like these earnouts.
Yeah. Yeah, it's, as you said, there's always a push and pull, because the buyer's preference is, it's our company, we're gonna do whatever the hell we want, and we'll let you know if you got a check at the end of 2 years. And obviously the seller is gonna say, no, we want, hourly income statements, and we want to be in there every day, making sure that everyone, basically we're still running the company the way we want to do. And they want to say, you're not allowed to fire anyone, and you need to devote a certain amount of resources to make sure that this business at least earns $1 more than it needs to earn for me to get paid, because that's really what the concern is. Okay, so, oh, sorry, one last thing here, I know we're moving slower than we need to. Almost all deals are done on what's called a cash-free, debt-free basis. which means any cash that's in the business is gonna stay with the seller. Any debt that's in the business has to be paid off by the seller. On an asset deal, that's really simple, because the cash just stays in the seller's bank account. It's not gonna be a purchased asset. The debt is gonna be an excluded liability and stay behind, so the seller has to pay that off. On a stock deal, when you're buying the company itself, you don't get to leave behind and take and all that sort of stuff. Everything just stays where it is. So we handle that through adjustments to the purchase price, typically on a dollar for dollar basis. Every dollar that's in the company's bank accounts increases the purchase price by $1. Every dollar of debt will decrease the purchase price by $1. Similarly, you'll often see adjustments done for working capital. The idea being when a buyer buys a business, their expectation is to buy a going concern. They want to buy a business that runs itself. They don't want to write a check for $50 million to buy a business and then also have to write a check for another $5 million because they got to make payroll on Friday and because they have vendor bills that are coming due. They're going to expect that there's going to be a certain level of working capital in the business existing on the closing in order to run the business in the ordinary course the way it always has been. Yeah.
How do you work with the working capital issue if you've got like subordinated debt? Like certain maybe shareholders themselves have certain subordinated debt to the company where that's kind of providing the working capital. So they're gonna go ahead and pay that off and then have to additionally
Yeah.
replace that subordinated debt?
Yeah, so debt would always be paid off in full. Buyer's not gonna take a business with debt on the books, almost always. I mean, I don't wanna say never, but that's generally not the framework. To the extent that the company is relying on that for working capital, I mean, you would have to factor in that calculation in terms of how that's gonna flow through the working capital. Typically, the way it works is buyers and sellers sit down, their finance people, their accountants, they come up with what the target working capital is, which means this is the number based on the way this business has been operated for the last 6 months, 12 months, 5 years. It needs X dollars of working capital, which includes, on the plus side, inventory and receivables and some prepaid expenses. On the negative side, we're talking about accounts payable and accrued expenses, and basically figure out what's the spread between the plus items and the minus items that allows this business to just, run as a churn. I mean, it's essentially, it's not quite cash flow, but it's a similar concept to cash flow. What's kind of like the monthly churn of this business, money in, money out, that allows it to run in the ordinary course. And that too will also usually be adjusted dollar for dollar. So if our expectation is that you're gonna have $1 million of working capital in the ordinary course in this business, and you show up at closing and you only have 800,000, so there too, you would be expected to inject an additional $200,000 as the seller into the business to get to that level. And it works the other way. If you show up to closing and we have $1.5 million just because sales were up and, depending on the day, anyone who has a bank account, right? Depending on the day of the month, if it's the day between when you get paid and you haven't paid your mortgage yet, feels like you have a lot of money. You check back in 10 days, you have not as much money as you thought. So it could depend on the day of the month that you close. It could be artificially high or low, and that's why we need to have these adjustments. It's also there to prevent sellers from manipulating the numbers, right? If I know I'm selling next week, I could call up all my customers and say, pay me this week, get all those receivables cleared out, call up all the vendors and say, oh, I need a little bit more time, we'll pay you in a few weeks, not mention anything about a deal. And then we show up to closing and, oh, so sorry, there are no receivables, there's lots of payables, enjoy your new company. So the working capital adjustment prevents against that. Escrows, we can kind of talk a little bit more about when we get to indemnification, but the concept is a buyer will often require the seller to take 5%, 20% in that range. 10%, I think, is the most common number, and you leave that behind in escrow for a period of time, usually between 6 months, 2 years, in the event that there's a problem. Now I don't have to chase after you, I don't have to bring an action against you. There's money sitting in an escrow account that is there exactly for that purpose. Okay, in terms of the closing, there's two general ways to structure a closing. Either a closing will occur today, the day we sign the agreement, we call that a simultaneous sign and close, or kind of similar to what you do when you sell a house, right? You go to contract and then you start the whole process for financing, you hire an inspector, you do all these various things and make sure that everybody wants to close when the closing date comes. We see simultaneous sign and close happen more often. It's easier, it's simpler. It creates a higher certainty of closing, because once everybody agrees that we're doing the deal, we're just closed. There's nothing else to be done. The main reasons why you would want to have a non-simultaneous sign to close. Number one, most common reason is if you need some sort of regulatory approval. Like we talked about before, if the Department of Health, Department of Labor, somebody needs to approve the transaction, you can't have that approved until you have to have a signed agreement to show them, and only once they approve, you can close. More and more common, the Hart-Scott-Rodino Act, any transaction that's above $111 million needs to be approved by the US Department of Commerce, Antitrust, whatever it is. I think it's Department of Commerce, but it's antitrust approval. And the other reason is, we talked about before, if there are any consents that are required. So if there's that major customer, that major landlord, if the buyer needs to go get financing, you may want to have this interim period, so that way everyone can get their ducks in a row before we close. Yes.
Got it. Great job so far.
Thank
Quick
you.
question on due diligence.
Yeah.
Of course, a lot of times you see quality of earnings done on the buy side. Of course, now we're trying to also advise our clients on the sell side to do a Q of V.
Yeah.
What are you seeing in the space from a Q of V standpoint? And then in the due diligence process, what are some of the biggest mistakes you've seen?
So yeah, I mean, Q of E is definitely becoming, as you said, more popular on both sides. The earlier the better. For all the same reasons we're talking about these things. The sooner you know what you're dealing with, the easier you could address any problems. Ideally, you never want to wait for a buyer to come to you and tell you a problem. You want to get out ahead of it. You want to tell them, hey, we noticed that, the July numbers were down, and here's why. Or, especially, you're dealing with a seasonal business, you want to explain to them the peaks and valleys. You want to be able to tell them that, revenues were artificially high or low, or expenses were artificially high or low because of something that was going on, because we've been running these expenses through the business, and, we're not gonna do that anymore. But the sooner you identify those with your seller, fix them, get them cleaned up in a way that you can present them to the buyer and explain them, because more important than what is done is the context often. You never want surprises. In terms of due diligence, the biggest mistakes that I would say sellers make is that they're so geared up to close that they want everything to move faster than is realistic and that is for their own good. It's better to close a deal right 3 weeks from now than to close it wrong today. And very frequently sellers will get a magic date in their head of when a deal is supposed to close. And that date is almost always based on nothing other than it's a date that somebody said at some point. And then everyone becomes fixated on that date. If we don't close by that date, and it's hard because you want to satisfy a client, but you need to reassure them that, in a year from now, no one's going to remember or care if the deal closed on March 1st or March 21st. It's not relevant, but you will care if in a year from now you get hit with an indemnification claim because you forgot to disclose that this contract had a termination provision and now buyer lost its, third highest customer, and the business that they bought for 10 million, they're saying is now worth only 8 million because they lost all that revenue, because we missed something.
Based on when they plan their vacation, by the way.
Yeah, that too. The number of sellers for whom selling their business does not feel like an urgent, pressing matter always astonishes me.
I would just add, Avi, that I think you do want a target date of close.
I agree with that.
Because
yes.
everybody works towards a date. It doesn't mean it has to happen on that date.
Yes,
But if you don't put a date out there, then it can just meander.
I agree.
Lawyers and
yes.
accountants notoriously work towards dates.
Dates are helpful as long as everyone understands that the day after the deal can still happen.
Yes.
It's not actually an emergency. But yes, they are helpful to keep people moving and, heading towards a target date. All right, I'm gonna try to pick up the pace. Reps and warranties. So in some respects, reps and warranties are the blood bone of the purchase agreement. It's really one of the most important things, because this is the section of the agreement where the seller tells the buyer everything about its business that the buyer cares about. And it serves two main purposes. And these are, as I said before, a representation is a statement of fact, usually as of a specific moment in time. So as I said, two purposes. Number one, this is like, it's a backdoor checklist way for buyer to do its due diligence. Because the way that representations work is we make a representation that says something to the effect of, except as set forth on Schedule X, we are not currently subject to any litigations, which sounds great. Except when you turn to Schedule X, then you see a list of 40 litigations that we're currently embroiled in. So in order for the seller to make that representation true, that there are no litigations, they need to populate that schedule with all of the exceptions. And that's a way that a buyer learns about what those things are, decides, oh, is this really a business that we want to buy? And number two, this is how buyer protects themselves in the event that there's a misrepresentation. Because if I say there are no litigations, and then it turns out there are 3 litigations, and now buyer has to deal with those litigations, buyer's not going to be happy. And buyer's going to expect to be made whole. We usually divide our representations into 3 buckets. We have our fundamental representations. These are representations, things like, I own the company and the shares that I'm selling to you. The company has title to its assets. We have the authority to enter into this agreement. These are the types of things that, if they're not true, the sellers are essentially committing fraud. And that's why they're called fundamental representations. They typically will survive for an indefinite period of time. So if it takes us 10 years to discover that you sold us a company that you didn't own, we could still come back to you. There's not going to be any caps. If we suffer $100 million of damages, it might not matter that we only bought the company for you for $50 million. As I said, these are misrepresentations that essentially constitute fraud. So all the limitations and all the protections that you can get for a seller are generally not going to apply if they breach these. And I generally tell my clients, if you're breaching these, I don't want to hear about it. Hire another lawyer to defend you because you're committing fraud against me too. Then we have our second bucket, which are like intense areas of law that have what are called successor liability. Areas like taxes, like environmental, to lesser extents, employee benefits. Sometimes intellectual property is considered part of this. And buyers more sensitive to these because the asset sale structure doesn't necessarily protect them against these liabilities. Taxes being the most classic example, there's no way that the government is letting anyone get out of taxes that are owed just because you sold the business to somebody else. They're going to go after the buyer. They're going to go after the person that the buyer sold to until the end of time for the IRS to get their money. So a tax representation is going to be held to a higher standard than our general business representations, which are things like, here's a list of our customers and suppliers, everything is good with, our supplier relations. Here's our, warranty policy, things that kind of just relate to our ordinary course running of our business. Those are going to be within the business representations, and the survival periods will kind of match up with either of these. Some fundamental representations last the longest period of time, usually at least 6 years, sometimes forever. Successor representations will usually last until the end of the statute of limitations. So once the period of time passes that the person can't come after the seller, they also can't come after the buyer. And then your general business representations, always negotiated. Usually between 6 months and 2 years. Generally, it's usually going to match the length of the escrow. Okay, we'll try to wrap up in the next 2-3 minutes. Well, we went through all these. These are, the examples of the different types of representations. The other extremely important thing that a buyer is bargaining for, in some ways that's like other than like physical possession of the assets. In certain businesses, the non-compete is really all they're getting. You think of like a service business, a consulting practice, a law firm would be a good example. Typically doesn't have a ton of like hard assets, doesn't have patents, doesn't have, formulas and, proprietary information. They have what a service business has is goodwill and, name in the marketplace, and has a list of customers. What you're really selling to a buyer is that I'm going to get out of this business, and these clients, these customers are now going to belong to you, and you're not going to have to worry about me servicing them anymore. If anything, I'm going to be working for you, helping you serve that client base. We usually see 2 to 5 years. Again, it depends on industry, depends on geography. You always want to be careful about the scope in terms of what is the business that you're actually agreeing not to compete in? Especially, you see business owners that own multiple businesses that might be related. You want to make sure that you haven't excluded them from continuing to run their other businesses by agreeing to a non-compete. You're always going to expect that they can't go after your customers, your suppliers, your employees. That's called a non-solicitation provision. Of course, there's going to be an expectation that a seller maintains all confidentiality. You can't, post trade secrets on the internet of the business you just sold, or even tell anyone that transaction has happened sometimes. All of that is confidential information to the buyer. Depending on the deal, seller might agree to provide transition assistance for some period of time. And you always want to make sure that you've addressed in the contract what's going to happen to the employees. Is there a guarantee of hiring employees, keeping them for a certain period of time, matching compensation and benefits? Depending on the business, there might be certain key employees. You might want to set up some sort of an incentive pool or enter into employment agreements with the most important employees. But those are always dealt with on a deal by deal basis. And now finally, the last section, we kind of talked about it before, but indemnification is basically the buyer's ability to claw back money from the seller or pursue other remedies in the event that something goes wrong. And the two main things that can go wrong is seller breaches one of its representations or it breaches one of its covenants. And as a result of it making a misrepresentation, we told you we've always paid our taxes. We told you that no one is infringing our IP. Then it turns out we were either lying or made a mistake, depending on the nature of it. We feel that the business that we bought is not worth what you paid us. We've suffered a damage. You need to make us whole. Now, we talked about before, you have your escrow available. If you want to bring a claim against the escrow, you also typically would have the ability to bring a claim directly against the selling shareholders. From the seller's perspective, there's always limitations that you want to put on that. You're never going to get a get out of jail free card. I wouldn't say never. Generally speaking, you're not going to get a get out of jail free card unless you purchase rep and warranty insurance, which is an excellent product that is used on higher price deals where essentially an insurer will step into the shoes of the buyer and the seller, and absent fraud, if there's a misrepresentation, they will cover that damage. It costs money, but depending on the context of the deal, it could make a lot of sense. You could quantify that loss and just pay a premium rather than, having to sit sleepless nights for 2 years wondering if buyer's going to bring a claim. But absent having an insurance policy, the best things you can do is you want to put a deductible basket on that, so the buyer can't bother you for a de minimis claim until we hit a certain threshold. We're not going to be liable to you. On the flip side, you want to put a cap. You'll never want a cap higher than the purchase price, because obviously you never want to sell a business and then owe more money than you got to begin with. And ideally, you want to negotiate that cap down as far as possible, whether it's 10%, 25%, 50%. And generally speaking, the higher the deal, the lower the cap on a percentage basis, because $1 billion deal doesn't necessarily need as much cushion to cover for damages as a $1 million deal. But obviously buyer wants it as high as possible, seller wants it as low as possible. And there'll also usually be some back and forth about the types of damages, whether we can get coverage from the buyer side for indirect, consequential, punitive. There's various types of damages that a seller will want to exclude and limit it only to the buyer's direct damages to the extent possible. Okay, I know this was a lot. I dumped on you in a short period of time. So to the extent there's any questions, you want to follow up on any specific piece, we can deal with those now. But of course, my number and my information is on the screen. Everyone should always feel free to reach out and treat me as a resource. Yes,
I just
Gary.
wanted to add, we actually try to get reps and warranties insurance on every one of our deals. And you could almost get to $5 million
Really?
value now.
Interesting. I was just
Yeah.
told 10 million is kind
Yeah,
of like
10, but we actually have someone who could do 5, amazingly.
interesting.
But we try to do that on every single deal, because of the escrow. As opposed to 10%, it's more like 1%.
Yeah, it's more work and more money in the short term, but it makes everybody sleep a whole lot better.
But once you're getting down to 5 million, who's typically, are they split in that or is typically the?
Yeah, usually they split the cost, yeah, buyer and seller 50/50.
When you get into this insurance business, so they themselves are doing some kind of due diligence.
Yes, they do a lot.
Right,
of
and
it.
and is that some, does that affect the extent of due diligence on the buyer's side, if there's that kind of diligence being on the insurance company?
Everyone has to do more due diligence on an insured deal.
Right.
Yeah, the insurer who's underwriting it has no upside in the deal. They only have the possibility of writing a check if something goes wrong. So they're not gonna, a buyer will sometimes say, okay, we've done our diligence, we haven't gotten everything, we really love this company. We don't think something's gonna go wrong. We're gonna take a calculated risk and hope for the best. Insurance company's not gonna do that.
Right.
So yeah, seller, the work product that seller's gonna have to deliver to buyer, and then buyer in turn is gonna have to deliver to the insurance company is often gonna be more rigorous. So it's something you need to also let a client know some of their costs, upfront costs will be higher because of the additional process, but it pales in comparison to the potential exposure if they get hit with a claim.
Costs about 1.5%.
Yeah, and honestly, it's like the most important thing is you could quantify it. So like you know what you're dealing with. It's just it's the same way you have to pay your accountant to do the Q of E. You gotta pay the insurance company and it's just, it's in the flow of funds and you're done. Now, some sellers are just like, I have a clean company. There's not gonna be a problem. Why am I writing a check to an insurance company? But at least they have that option. Anything
Yes,
else?
it's good stuff.
Thank you, Abby.
So, I'd like to kind of go out a little bit. I know Abby went into,
Sorry about that.
no,